Hello friends, this is Orville David here. Welcome to Adventure Terrain Ventures. Let's now continue our discussion on the types of traders. So this week we're going to talk about a proprietary equity trader and an equity options trader. So basically, who is a proprietary trader? A proprietary trader is one who trades in his own account using his own capital. As simple as that. So there are some traders, probably very high net worth individuals, who take membership on the National Stock Exchange or any of the exchange for that matter. And they have their own capital and they go on the floor of the exchange and then they trade. Now, these are specifically called proprietary traders. So a person who is trading through another broker can also be a proprietary trader. But basically, we call those guys or those traders who trade on their own account and not on behalf of a client or not on behalf of someone else. These are called the proprietary traders. So what are the markets that these proprietary traders could trade on? Basically, the equity market is one where there are a lot of companies shares getting traded. So these proprietary traders, they would be trading, buying and selling stocks. So basically we have the stock market and we have the traders in the stock market who trade in equities. Apart from the stock market, we also have the commodity market. Now the commodity market is a pretty big market where there are base metals getting traded. There are bullion getting traded like gold and silver. There are these energy products getting traded. For example, natural gas and crude oil. All these commodities are traded in an exchange in India called MCX, Multi Commodity Exchange. And there are also agro commodities that get traded, so agriculture based commodities that get traded, and all these get traded in another exchange called the NCDEX. For the equity markets, we have the National Stock Exchange and we have the Bombay Stock Exchange in India. And internationally, we have various other exchanges that are traded. But the Forex markets are a bit different. Forex are currency markets. So they trade, one currency of a country trades against another currency. And that's why it's called currency pairs or Forex pairs. So you have, for example, the US dollar trading against the euro, or you could have the euro trading against the Indian rupee. So in India, we have the National Stock Exchange trade, you could trade certain currency pairs, but all against the Indian rupee. And these are basically currency futures that get traded in the Indian market. However, globally, we have spot currencies also being traded, and most of them, these are decentralized exchanges. So you wouldn't see spot currencies being traded in an exchange. They are decentralized exchanges, and then you have these currency futures internationally as well being traded in various exchanges. Another type of trader we're going to talk about today, they are called the equity options trader. Now these traders, they are specializing in trading options alone, and more specifically options of equities. So you could have options of various different assets, so you have options in forex, you have options in commodities, and we have options for equities. So they specialize basically in trading options, and they could be trading for a salary, or they could be even trading on their own account, or they could be having some kind of a profit sharing arrangement with another trader. But what are these options basically? What are options? So let's understand that, because they are very mysterious instruments, and many people keep asking me this question as what actually are options. So basically options are contracts. So it's a contract between a buyer and a seller. So they are contracts that grant the buyer of the option a right, but not the obligation to buy or sell an underlying asset. In this case, the underlying asset is an equity. So for example, a stock, like maybe talking about either Reliance, or you can talk about SBIN, or we can talk about Tata Motors. Now all these stocks, these are the underlying assets, and they have option contracts being traded in the exchange. So the buyer of these option contracts, they have a right. Okay, they are given a right to buy a stock at a specific price, or they could even buy a right to sell a stock at a specific price. And all these contracts have an expiry date. So options have premiums. For this right, the option buyer pays a premium to the seller, and the premium price itself keeps going higher and lower depending on how the underlying asset moves. So if you see the Tata Motors price going up, you can have the Tata Motors call options also going up, and the premiums of the Tata Motors put options would be coming down. So basically, these are very advanced trading instruments, and it requires a lot of expertise to be able to trade options. So there are some traders who specialize only in trading options, and they make a great deal of money by trading options, either for themselves or the trader whom they are trading for. So how is trading options different from trading equities? So let me just put a few points across to you to just give you a brief idea as to how are trading options different from equities. First, let us look at it from the point of view of investment. So usually if you are buying a stock, you need to pay the full price for the stock. So for example, if you are buying, say, Tata Motors, which is priced at 250 rupees, and you want to buy, say, about 1,500 shares, so you have to pay 1,500 into 250, which is 3,75,000 rupees. So that is the investment required to buy stock. However, if you are buying an option which has a strike price, say for example a call option which has a strike price of 250 rupees, you would need to pay only the premium. The premium could be, say, about 20 rupees, and if you are buying about 1,500 options, so you would be ending up paying just about 30,000 rupees. So that's 1,500 multiplied by 20 equal to 30,000 rupees. So, the investment to own Tata Motors call option is just about 30,000 rupees, as against 3,75,000 rupees if you are owning stock. So, however, an owner of an options is not entitled to dividends or any corporate actions that are given by the company, as he is only having a right to buy, but he is not yet the buyer. He is not yet the owner of that particular stock. So he would be able to become the owner of it after he pays the full amount on the expiry date. Till then, he will be only having the right to buy, though not the obligation. So the investment that he has to put in would be far lesser as compared to that of a equity trader. How about the risk involved? Now, the risk involved in the case of an equity trader could be, the fall in the value of the underlying asset. For example, Tata Motors, if it is at 250 rupees, it could fall down to even 200 rupees. And, he could lose about 50 rupees, from his investment. However, in the case of options trader, if he has paid a premium of 20 rupees and the stock fell down to 200 rupees, that entire premium of 20 rupees he would lose, as the call option would now fall from 20 to 0 on expiry. So, he is having a right to buy, but he has, a limited risk, a risk limited to only the extent of the premium that he paid. So if he has paid a premium of 20 rupees, his maximum risk or the maximum amount he could lose is just 20 rupees, even if the stock fell down by 50, 100, or even if the stock went down to 0, he would not lose anything more than 20 rupees. So he has a very limited risk, the options trader. From the point of view of returns, now if you look at the return on capital invested, say the Tata Motors went up from 250 rupees to 300 rupees, he would make about 50 rupees. So that's about 20% on your capital invested. However, an options trader in the same scenario, would make much higher, because the option premium, which was at 20 rupees, would go up to 70 rupees by the time the Tata Motors stock went up from 250 to 300. So an investment of 20 rupees would give him a return of 70 minus 20, 50 rupees. So you see the returns is almost 250%. So it's much higher in the case of an options trader. So he takes a limited risk, and he can, the reward that he gets for taking that risk is unlimited, because if it goes up 50 rupees, he makes, 50 rupees. If it goes up by 100 rupees, he can make even 100 rupees. So the returns is unlimited. So what is exactly the case in the case of equity? Do you have leverage? In the case of equity, we don't have leverage, because you're paying 100% of the money and you get returns only based on the value of the stock that goes up or down. However, options are highly leveraged products. In other words, you can control a much bigger amount of investment or a capital with only a small investment. You can control a big contract value with a small investment. So, when you buy one lot of call option at a premium of 20 rupees, if you are expecting it to go to 250 rupees, if you are expecting Tata Motors to go up to 250 rupees and you are paying a 20 rupees premium to buy the call option, 250 into the lot size of 1,500, 3 lakh is equal to 3,75,000 rupees. Now 3,75,000 is the value of the contract, though you are paying only 20. So you are paying 20 rupees and controlling a contract value of 3,75,000 rupees. So definitely they are highly leveraged instruments. What about costs? So basically the cost for trading equities would be the brokerage that your broker would charge you for buying that stock. So if you are paying a brokerage of say 0.5% or 0.25% on the total value of whatever you have bought. That is your cost. Plus, of course, you would need to pay the taxes, the statutory charges, plus the brokerage. The brokerage and statutory charges are the charges which you pay as a percentage of the contract of the value of your investment. However, if you are buying an option, okay, the cost again would be much lower because you're not going to pay it as a percentage of the value of the contract, but you would either pay a percentage of the value of the premium, or you would pay a flat price for the whole contract. So as such, the cost for dealing in options is far less as compared to dealing in equities. So what is the kind of a compensation that these traders get? So these traders basically get a compensation in the form of returns or salary. A proprietary trader would only get, his returns. So there's nothing assured for him. There is no assured return for him, as he's trading on his own account, and if he makes a profit, that is his compensation, right? So it's all about his ability to trade and generate returns in the market. However, for an options trader could be trading probably on behalf of another trader. So depending upon the management accounting principles of the fund that he is trading for, or the trader that he is trading on behalf of, he could either be drawing some salary on a monthly basis, or he could be even drawing salary plus some incentives in the form of a share of the profits that he made for his fund or for his trader. So it all depends, as to what kind of a compensation an options trader would get. So these are the basic distinction between the proprietary trader and an options trader. So let us now switch gears and have a look at a trade which I took last week. So this is a stock called SAIL, and this is a 15-minute chart of SAIL. So if you can look at the chart right here, we had a rally in price, a period of pause, which lasted for approximately 1, 2, 3, 4 candles. 4 candles in a 15-minute chart is 20 minutes. So 4 candles, period of pause, and then a sharp rally up. So that rally up was also followed up by some more rallies. So what I did is I drew a green zone here representing a area of demand or a demand zone, and I just mark this entire area as an area of demand. Now what do I do usually when I mark an area of demand? Of course, the rules for marking an area of demand we won't discuss today, we don't have time for that, but then in our course, the Stock Market Model Street, we will discuss in great detail about how to identify the area of demand exactly. So what I do is, once I mark an area of demand, just above the area of demand, I put my entry, which is at 78 in this case, and just below the area of demand, I put my stop loss, which is 77.25 in this case. So once I have planned this trade, all I do is place my entry, stop, and my target price. My target is usually 2.5 times the risk that I take. So the risk that I took here is 75 paise. So my target should be of 1.9. So I place my target at 79.90. So we placed a bracket order with the entry, stop loss, and target. So if you're wondering what a bracket order is, it's a kind of a order placement mechanism which is offered by certain brokerages. And since I trade with Sher Khan, I have this facility which Sher Khan provides me to place a bracket order. So this order is placed quite early in the morning before the market opens. I place the order at 9 o'clock itself. And the system, Sher Khan servers are they are very quick to send the orders at 9:15 to the exchange. So you can see what happened the very next day after I planned the trade. This is the point. This is the very first candle of the next day. So as you can see, this candle, if I could enlarge it, it's a green candle. So this is the open. After the price opened here, actually the price opened very close to my target. Okay, and if I was watching the market, I would have never thought it will come down into my area of demand. But that's exactly what happened. The market came down within a few seconds. It made a low which is very close to my entry price, rather just below my entry price. Okay, so my entry price is 78. Let's look at what is the low this candle made. So the low this candle made was 77.65. So it made a low of 77.65 and immediately rushed back up all the way above my target till here. So within a single candle, I got my entry and I got my target as well. So unless I had placed this order as a bracket order prior to market opening, I would have never been able to catch this trade because it happened so fast. This candle is a 15-minute candle. So market opens at 9:15 and before 9:30, my entry and target both were completed. In fact, by the time I actually saw this trade, I was already out of the trade, right? So it's not possible sometimes to manually place orders or watch the market and place orders. It's always better to place a bracket order prior to market opening. So this is how I traded sale. So let's now go to our weekly analysis of the index, that is Nifty. So this is what our markets are doing. They are just coming down a little bit from a new historic high which it made. So if you can see this area of the chart, there's hardly any area of demand or area of supply. So it's very difficult to take any trades in Nifty alone. Let me just remove this 15-minute demand zone which I had marked. Yeah, so now it's more clear for you guys to see it. So as you can see, this whole area right here, there is no real demand anywhere, except maybe some demand could be here because this is a pro gap. You see the price gapping against the previous direction. So there could be some demand over here, but I really wouldn't want to fall on this demand and buy anything at this point of time. I would rather look at my weekly chart to see what's happening on the weekly chart. So as you can see here on my weekly chart, I have this area of demand right here. So from 10,925 all the way up to 11,076 is an area of demand. So I would like to buy at 11,076 and keep my stop loss at 10,925. So of course I will re-evaluate the trade when price comes closer to this, because I would definitely need to see enough reward to risk ratio for such a big zone. Unless I can see good reward to risk ratio, I would not take long positions though. Let's look at the monthly chart. Now, if you look at the monthly chart, what you can see is here we have a rally, a period of pause and a rally. So this is again a monthly demand zone, right? And if I should draw the monthly demand zone, it would be something like this. So as you can see, the weekly demand zone is just above the monthly demand zone, right? So it's a good idea to take a long position at this weekly demand zone. So if I come back to my weekly chart, so this is an area which I should think of taking long positions. So another question that usually comes to me is, if you're expecting price to come all the way up till down till here, why don't we go short right now, and when it comes down you can cover? But the fact of the matter is that there is no probability to say that it will really come all the way down till here. My only point I make is, if it does come down till here, there is a good probability it will turn up again from here. So it's better to wait for this and then take your long positions rather than trying to go short right here. So I would wait for prices to come all the way down here, or I would wait for any new areas of demand or supply to be created before I can take a trade. So it's always not a, I never trade at any price level on the chart. I only trade at prices when they enter my areas of demand or areas of supply. So that's all for this week. It was really nice talking to all of you. If you want to learn more about demand and supply, join our course. It's called the Stock Market Model Street. You can get all the information about the course in our website, that is adventureterrainventures.co.in. Thanks for watching. I'm Aurel David, signing off.